The Australian dollar has traded on the front foot this week, trading from around 79.50 to around 80.5 US cents today. But really, it's been a story of broad-based US dollar weakness, with all G10 currencies up against the US dollar on the week. There's been a busy week for markets, with plenty of data released domestically, as well as offshore central banks and the RBA, as well as political intrigue and the weather impacts of hurricanes in the US. Firstly, turning to central banks, the RBA announced their September decision earlier in the week, keeping rates unchanged as was widely expected. This was ahead of the key Australian GDP data, but the RBA certainly sounded a slightly more upbeat tone, more positive language around employment and wages, as well as the outlook for non-mining investment. Bank of Canada was next, increasing their interest rate to 1%, following their July interest rate hike as well. That saw the Canadian dollar rally strongly, up 2.3% on the week, as markets had been pricing this about a 50-50 chance in the lead up to the meeting. Given the high-level similarities between the Australian and Canadian economies, we did see some people drawing parallels to the RBA. A reliance on commodities, a highly indebted consumer, high house prices. But here, we're not so sure. Canada has been growing quite strongly, whereas domestically, we've seen more of a subpar acceleration in economic growth. Lastly, we had the ECB announcement last night. And here, policy rates were left unchanged, and there were no comments regarding their QE, or quantitative easing program, which is scheduled to finish in December of this year. That saw the euro rally strongly in response, above 120 US cents, a 3-year high. Turning to domestic data, the headline was Australian Q2 GDP, which rose 0.8% for the quarter, or 1.8% through the year. There were a number of positives in the June quarter, suggesting that the overall economy gained momentum in mid-2017 against the backdrop of stronger world growth. Key positives were a lift in public demand centred on ongoing investment, a lift in employment, as well as a lift in service exports, which increased to meet demand from the Asian region. However, on the downside, consumption gained just 0.7%, with households facing fundamental headwinds of weak wages growth, resulting in lacklustre consumer spending patterns. So all up, GDP represented something of a mixed bag. Updates to July trade and retail sales later in the week also disappointed expectations and suggest weakness as we look forward to the second half of the year. July retail sales was flat. Retail had been affected by Q1's wet weather, but clearly this result showed fading momentum. This affirms weak readings as we look forward to the second half of the year and the impacts of that weak wages and consumer backdrop we spoke of earlier. Perhaps most significantly though for markets, we did see President Trump make an agreement with the US Congress to extend the US debt ceiling and funding for the US government from mid-October to mid-December. While this perhaps has avoided short-term risks for the US government, ultimately it just moves the problem to December and perhaps complicates the outlook for the Federal Reserve, who meet on December 13th. Next week, we see US retail sales and CPI data. Domestically, we get updates on business and consumer confidence. This will be important. We've seen an ongoing divergence where businesses have been optimistic, but the Australian consumer remains firmly pessimistic. We also get updates on labour data later in the week. Again, watched for signs of ongoing strength, where the Australian economy has been producing a strong run of jobs growth of late. The Australian dollar looks likely to finish this week above 80 US cents. And that strength looks likely to continue into next week. The commodity outlook remains supportive, domestic data has been strong, and the US dollar remains firmly out of favour. All these factors, we look forward to talking to you next week.